I'm just about to see like a lot today. It's like, oh shit, so I learned to see everyone was one small open. It's like, that's and I was happy with that. Having so I'm going to do the first one, but I want to go about it. Maybe for a car, that's that was a 15 mpg. So all the people that like kind of go home and I just hook it down right hand and go. So, yeah. Like you couldn't sorry, you couldn't use negative. Yeah, right. Oh, that's the thing. Like nauseous inside like for 2 years. So that's like sometimes if someone would sell it for years. All right, it's 1 o'clock. Let's go and get started. All right, good afternoon, everyone. How's everyone doing today? Hanging in there? I'm sure you guys are probably busy with midterms and midterms and lots of stuff going on. So thank you guys for coming today. Speaking of midterms, we have our midterm for this class on Tuesday, so make sure you guys are here for that. So we talked about the format for the midterm on the previous class 2 days ago, and I think I sent out an email as well, kind of outlining everything that you need to know. So just a quick rundown. Remember, you can bring your writing utensil, calculator, cheat sheet. Your cheat sheet can be 8.5 by 11, both sides. Study guide is on Canvas as well as the solutions to the first two homeworks. Once the due date for homework 3 has passed, then I'm going to post the solutions for homework 3 as well. Right? So I know I'm a little bit behind on the grading. I don't think I've graded homework 2 yet, so I plan on doing that tomorrow. So it's kind of been a little busy, hectic semester for me as well. So hopefully I can get that done by tomorrow. Okay. All right, so the topic for today is going to be taxes, and so all about taxes. So really exciting stuff. Nothing gets your blood boiling than talking about taxes, right? But I think when you think about it from like an engineering business point of view, in terms of what engineering businesses and projects are trying to do with their taxes, I think it becomes a bit more interesting, hopefully. Okay. All right, are there any questions I can answer before we get started for today? Okay. All right, so let's go and get started. Let's talk about taxes and depreciation. All right, so I'm kind of grouping, two topics in one, but they both kind of go together. So, I think the concept of taxes is not new to people. I think everyone kind of knows about taxes. It's in the news a lot. But I think talking about depreciation is a little bit new. So, we'll kind of talk. We'll spend the first part today just talking about just taxes in general, just to make sure we're all on the same page. And then we'll start talking about depreciation, define what that means and how that affects the taxes that a business has to pay. Okay. All right. So just very basic. So I think we went over this last time, but taxes are collected by the government. And they're primarily used to fund the government's operation. So that includes, all the administrative offices, but also all the public works offices as well. So fire department, police department, state-run schools like this one. Okay. And the way taxes work is that taxes are normally paid based off a percentage of your income, or based off a percentage of the amount of money that you make. And so the general idea behind that is that the more money that you make, the more that you pay in taxes to, so that everyone kind of pays their fair share, right? And so the very simple formula that we have is the amount of taxes that you pay is equal to your income multiplied by the tax rate. Where this income here, this is going to be the subject of kind of the first half of class today. This income is normally called taxable income. Right? Because what you can do, both as individuals and kind of more commonly for governments, is that you can deduct or you can subtract the amount of money from compared to the gross amount of money that you get, you can subtract or expenses away so that the amount of money that you actually get taxed on is less, right? So your taxable income is almost always all right. And so the idea behind this is that, if you're, and we're talking strictly for businesses here, but this also applies to kind of individual entrepreneurs, that if you're spending money to run your business to kind of participate in the economy in the United States, then the US government wants to give you a discount based on those expenses. Okay. That's how this idea started. So that's how this idea of deducting from your taxable income started, where the government wanted to give businesses incentives or bonuses for driving the economy, because the economy doesn't run in our kind of way of governance, it doesn't run without the businesses. So the government wanted to give these businesses incentives to do that. But now, if you kind of fast forward to 2024, it's exceedingly complicated. So you can get deductions for so many different things. And sometimes you need like an actual skilled, tax accountant or tax professional to really account for all your deductions. But that's essentially the idea, right? And so to compute your taxable income, okay, I have another formula for you. It's a fairly simple formula. And so the first thing that you're going to include here is your gross income. So your gross income is nothing more than just the total amount of money that you made that year, either from your business or as an individual. Okay. First thing you're going to subtract is what we call your ordinary and necessary expenditures. Okay. And I'll define what that means in a second. And the next thing you're going to subtract here are your depreciation um, amounts which are from your large capital purchases. Right. So not really, kind of a simple formula, but there's kind of a lot of things to kind of explain in that formula. So, but basically, think of it if you think of just the statement that I have above, where like to run a business, any kind of business, you have to spend money, right? You have to pay your employees, you have to pay for materials, you have to pay for maintenance costs, you have to buy equipment, right? Any money that you spend on your business, you can subtract that from your taxable income. Okay. All right. So let's give a little bit of a more of a concrete definition to each of these, right? So your gross income, is the total amount of money that you earned um, within a certain period, usually a year. Okay. And so if you're a business, your gross income will include things like revenue that you get from sales, right? Selling your product. A lot of businesses nowadays are doing more in investments as well. So any kind of gains that you gain from your investments, that all gets included in there. Okay. Next, we have ordinary and necessary expenditures. Okay. So ordinary necessary expenditures, these are costs that you need to pay to run your business. But generally, there's lots of different costs that are associated with running a business. But in terms of ordinary necessary expenditures, these are specifically the labor, materials, and equipment that you buy that lasts less than 1 year. So the idea is that once you pay this money out, it's gone. It's gone from the business. So you can think of, raw materials that are consumed through a manufacturing process, money that you pay to your employees. And so, the money that you pay to your employees, the labor cost, that once you pay that out, that belongs to your employees. So that's not property of the business anymore. Any kind of equipment that you are going to run through in less than a year. So, maybe that's like certain tools, tooling equipment, things that are kind of short-term investments. Okay. All right, and then finally we come to depreciation. So depreciation, this also has to do with costs that the business has to expend to run its business, right? But these are typically pieces of equipment that last more than 1 year. So these are kind of more longer term investments in equipment. Okay? So what you can subtract from your taxes specifically is the loss in value of that piece of equipment over this past year. Okay? All right, and so that has to do with the fact that if you buy a large piece of equipment, it's probably going to last you. Let's say that you buy a vehicle to run your business, right? You have a simple delivery business, um, and so you buy a truck. That truck is going to last you, 8, 9, 10 years, and so each year that you keep the truck, it's going to lose value just because the truck's getting older. You're using it more, right? And so the depreciation is specifically the loss in value of that purchase over that past year. Okay. And so you can consider that to be kind of a cost that you're spending as a business owner. Okay. Because if you were to take that truck and sell it at the end of the year, right, you're going to recoup a lot of your initial costs back. Maybe not all of it because you've used the equipment over the past year, but you're going to get some of it back. And so the only amount that the government lets you deduct from your taxes is that amount that it loses value. Okay, so we're gonna talk a lot more about depreciation probably in the second half of today. But I just wanted to kind of introduce that concept now, just so it's kind of in your mind. All right, so this is our simple formula here for taxable income. And then once you have taxable income, you can just multiply it by the tax rate to get your taxes. But that's kind of these two formulas here are kind of the crux of kind of everything that we're going to be doing probably over the next, at least week and a half. And so, I know we have the midterm on Tuesday, so we'll pick this up again next Thursday, and we may need the next Tuesday after that. Okay. All right, any questions on this so far? Okay. All right, so let's do a very simple example, with just very simple numbers, just to kind of get you used to this mindset. Okay. Okay, so let's consider the following cash flows for a company. So these are 3 consecutive years of a company's finances. Okay. What you're going to see from kind of here on out, our cash flows here are going to get a lot more complicated, especially when we throw taxes into the mix. And so you're going to see a lot more tables over the next few weeks as opposed to cash flow diagrams. All right, so each year we've listed out the income. So that's how much the company is going to make in that particular year. The labor costs, materials, and maintenance. Okay. And of course, these are approximate numbers, and so these may be in the thousands, right? So maybe we multiply these by 1,000 for each given year. Okay. So let's say in year 1 the company made $9,000 in profit. Okay. Next year they made 9,500. And year 3 they made 8,500. So they're around kind of averaging about $9,000 per year. Of course, that's 9,000 maybe multiplied by 1,000. A company only making $9,000 in income, maybe that's like a lemonade stand for for a kid or something like that. But multiply this by 1,000. That's probably a bit closer. Okay, so in terms of labor, on year 1 the company spent 2,500. Year 2 they spent 3,000. And year 3 they spent 3,500. Okay, so all those are negative because that's money that the company is spending. Okay. Next we have material costs. Year 1 they spent 500. Next they spent 750. Year 3 they spent 400. Okay. And then maintenance costs. Year 1 is 350. Okay. So all 3 years we're going to assume that we spent 350 on maintenance. Okay. All right. So then let's talk about our assumptions. Okay. So for this problem, we're going to assume a tax rate of 21%, which is about the average corporate federal tax rate. course, the exact tax rate changes on a lot of factors. Depends on who's president at the time and kind of what bracket of the of income that you're in. But we'll just, for the most part, we'll assume kind of an even 21% for all of our calculations. Okay. All right. So for each year, let's compute the taxable income. And we'll also compute the amount of taxes paid. Okay. All right, so pretty simple example. We're just going to take our income here. We don't have any depreciation, so all of these are just kind of what I consider to be ordinary and necessary expenditures. And so all we're going to do is we're going to take our gross income, subtract all the business expenditures for the year, multiply it by the tax rate, and that gives us the amount of taxes. Okay. All right, so we'll go year by year. So let's go year one. Okay. So first, let's compute the taxable income. The taxable income, start at 9,000. We're going to subtract 2,500. That was our labor cost in year one. Then we're going to subtract 500. Then we're going to subtract 350. Okay. So all of these here, these are our ordinary / necessary expenditures. Okay. So if you do this calculation here, we just punch it into a calculator, we get 5,650. Okay. All right, and then to compute the taxes paid, we just take our taxable income, 5,650. Okay. We're going to multiply by our tax rate. Tax rate is 21%. Okay. And we get 1186.50. Okay. So in that first year, we're only paying $1,186.50 of taxes. Okay. So you can see it's a big difference, right? So when you subtract all of your business expenses, you kind of, in a sense, you could say that you saved a lot of money on your taxes because you spent that money to give to your employees, to give to buy materials and to maintain your equipment. Okay. So this is really important because if we didn't do this, this business would probably have to pay about $1,800 in taxes. So that's a big difference. Okay, so let's do the same thing for year two. For taxable income for year two, we have 9,500. That's how much income that we made in year two. We're going to subtract our labor costs. So our labor cost is $3,000. Okay. Minus our material cost, 750. Minus our maintenance cost, which is 350. Okay. So we plug all of those in. Okay. Then our taxable income for year two is $5,400. Okay. Then our taxes is 5,400 multiplied by our tax rate, which is 0.21. And so the amount of taxes that we pay in year two is 1,134, okay, $1,134. And then just for completeness, let's do the same thing for year three. Okay, so taxable income here. We made a little bit less money in year three, so we have 8,500. minus our labor cost, 3,500, minus material costs, 400, minus the maintenance costs. So our taxable income for year 3 is 4,250. Okay. Then our taxes is just going to be that 4,250 multiplied by our tax rate, 0.21. And what we get is $892.50. Any questions on this? Right. Pretty straightforward. So, you take your gross income, you subtract your expenses, and then you multiply that by the tax rate. So, pretty straightforward. Okay. Before we get to depreciation, there is one kind of small caveat to this, which is state income taxes. So the 21%, the tax rate of 21% that we just talked about is the federal tax rate. So that's the amount of money you pay to the federal government. Okay? Some states in the U.S. Also impose their own taxes. California being one of them. We actually pay one of the highest tax rates in the country. Um, so that's separate. So a lot of people don't realize this just because they get their paycheck and all the taxes have kind of already been taken out. But if you live in a state that has state income taxes, you pay money to the state government as well as the federal government. Okay? And so at the end of the day, if your state also imposes taxes, this will increase your tax rate. But there's a small caveat that kind of saves you a little bit of money on your taxes. Um, so if you live in a state that does charge you state income taxes, you can deduct your state income taxes from your federal taxable income. And so one way that you can think about it is that if you're paying state income taxes, you pay those first. So you pay the state first, and then you don't double dip. You don't double dip on that same income to pay the federal government as well. Okay. And so we have a new definition here. So we have federal taxable income. Okay. So we have our first three entries the same as before. So we have our gross income minus ordinary expenditures We're subtracting our depreciation as well. And then we're also going to subtract our state income taxes. Okay. So it's one more deduction that you have to make. All right, and so if you conduct business in California, this should be very or this will become very familiar to you. Okay. Okay, so I have a quick example for this just to kind of illustrate this concept. Okay. Okay, so let's say that doing an example, California is a little bit too on the nose. So let's consider a company in Pennsylvania. Pennsylvania is another state that imposes state income taxes. All right, so let's consider a small design firm in Pennsylvania. Okay. So let's say that after they've already subtracted their ordinary expenditures and they've already subtracted their depreciation. And so they have a taxable income. And we're just going to do some rounding. So let's say that they have a taxable income of $100,000. So they've already done kind of step one of their tax filing. So they've already accounted for all of their business expenditures and all their depreciation, and they've subtracted that from their income, right? And what they get after that is $100,000. And so if the state income tax rate in Pennsylvania, so let's say that it's 10%, and the federal tax rate is 21%. Let's compute how much this company is going to pay in taxes for this year. Okay. So that is our problem. So when you first look at this problem, right, and you kind of are not aware that state income taxes can be deducted, you may be tempted to just simply add the two rates together. So you take 10%, you add 21%, you get a total tax rate of 31%, and then you multiply that by your taxable income, right? And so you pay about $31,000 in taxes. But luckily, because the state income taxes can be deducted first, the amount of taxes that you pay is going to be slightly less than that. Okay. All right. So for problems where you're given a state income tax rate, or even beyond this class, if you conduct business in California, you should compute the state taxes first. All right. So that's for the state taxes we're going to take our taxable income, and then multiply it by the state income tax rate. Okay. And so from this problem, our taxable income is $100,000. And our state income tax rate in this case is 10%. So we're going to multiply this by 0.1. Okay. And so if we do that, we take 100,000, multiply by 0.1, what we get is $10,000 in taxes. All right, so now we're going to compute federal taxes. So that $10,000 that we paid to the state already is already paid out. And so we're not going to, we're not going to be taxed on that again from the federal government. Okay. So first, before we can multiply it by the 21%, we're going to compute our federal taxable income. Okay. We're going to take our gross income, $100,000. Okay. We're going to subtract the state taxes that we paid. Okay. So we perform this subtraction, 100,000 minus 10,000. What we're left with after that is 90,000. Okay. And then we take this 90,000 and then we multiply this by the 21%. All right, so the federal taxes that we pay here is $90,000 multiplied by the 21%. And what we get after this is $18,900. All right, and so if you add these up, we pay $10,000 in taxes to the state and then $18,900 taxes to the federal government. And so in total, the total amount of taxes that we pay is $28,900. So that's not that much less, but still, less than what we originally thought, which is $31,000. So, we saved about $2,100 in taxes because of this rule. All right. Any questions on this example here? Okay. All right. So that's the basics of taxes. And so, whatever money that you make, just always know that the government's going to take a slice of it. So, and there's kind of different ways to go about it, but that's essentially how it is. All right. Now that we're kind of done with the basics of taxes, let's actually move on to the topic that's new, which is depreciation. Right. So depreciation, I would say depreciation has kind of an intuitive definition, intuitive kind of um, you know, sense of what it is, and then there's the tax reason. And so, we're kind of blending both together at the same time. So let's start with the kind of the intuitive definition for depreciation, and then we'll see how that factors into our tax calculations. Okay? All right. So I kind of did it reverse a little bit. So, at the beginning of class today, I kind of gave you the tax reason for depreciation. Let's kind of take a step back and talk about what people mean by depreciation in general. Because if you bring up depreciation in everyday conversation, 90%, unless you're talking to someone from this class, 90% chance they're not talking about taxes. They're talking about something else. So, all right. So depreciation. Depreciation refers to a loss in value of an investment over time. And so if you've ever purchased a car before, or your parents purchased a car before, someone you know purchased a car, you know that if you buy a new car, as soon as you sit in the car and as soon as you drive 1 inch, that car has lost a ton of value already, right? And so it from that moment on, it goes from a new car to a used car, right? And so depreciation is kind of illustrates that fact, right? The fact that if you buy something, you buy an asset. Usually, if you buy an asset that's intended to be used, that its value goes down over time. Okay. And it's just for the simple fact that as you use something, for a lot of devices, like your phone, your car, your refrigerator, your stove, right? The best, usually the point in time where they're going to be performing the best is right when you buy it, right? Because as you use it more, as you drive your car, as you use your phone, right? It's gonna accrue kind of wear and tear through use, and some problems may crop up, it may break, and things like that. Okay. Okay. So if we chart this out, right? So let's chart out a typical asset, or typical kind of piece of equipment. Let's chart out its value over time, right? And so, of course, the exact shape of this curve depends on kind of exactly what piece of equipment that you're considering. Maybe how well you use it. Of course, then it's gonna reduce the steepness of this curve. But in general, so on the horizontal axis here, let's have time, and on the vertical axis here, let's have value. So let's have money, right? And so at time zero, so right when you purchase a piece of equipment, that's when it's at its maximum value. Okay. Okay. And usually that value, or what you said is the value, is the initial cost, right? So whatever you purchased an asset for, whatever you purchased a car for, at that moment, that asset has that value. Okay. And then as you use it, so let's say that you use this car, you use this device over the years, its value is going to decrease with time. Okay. And so we can track this. And so let's say that, I'm just going to put markers here just fairly arbitrarily. So let's say each dot here indicates a separate year or a separate month. Okay. Okay, so this is year one, year two, year three, 4, 5. I don't know why I drew so many. 7. I didn't need to draw that many, but we did anyway. Okay. So the horizontal axis, we're going to say we're keeping track of the years. Okay. All right. So let's say that you're using this piece of equipment, and then, let's say after year three, you want to sell it, right? Okay. So if you sell your piece of equipment, and of course there's a lot that goes into selling a car, selling a phone or whatever, right? But on average, you can expect to get market value for whatever your equipment is, right? And so the amount of money that you get back can be determined from this curve right here. So of course, unless you're selling an antique or unless you're very good at scamming people, for the most part, you're going to be selling your asset, you're going to be selling your piece of equipment for less than what you got it at when it was brand new, right? And this curve shows that, right? And so if you sold at year three, if we kind of trace out kind of a horizontal line here to the vertical axis, the amount of money that you got from this is much less than what you got. Okay. All right. And that's normal, right? And so if you sell a used thing or whatever, you're going to get less from it. And so one way that you can look at this, right? So over those 3 years, right? If we take this vertical distance right here, okay, this vertical distance between, the initial value, what you bought it at compared to what you sold it at, this right here is what we refer to as the value depreciation, or the amount of value the asset lost. Okay? Because over that 3-year period, between the time when you bought it and the time that you sold it, it lost value over that time. So that is depreciation. Okay. All right. Any questions on this so far? Okay. All right. So now let's look at this from a tax accounting perspective, right? And so instead of kind of a personal device, let's say that this graph here represents the value of a piece of business equipment, right? So either maybe a large crane or something, or maybe like a truck that a business purchased, right? Okay. And just like the ordinary necessary expenditures, right? This piece of equipment is essential to running the business, right? You can't run the business without this piece of equipment. Okay? Each year that this business uses this piece of equipment, right? That equipment is going to lose value, right? Because at any time, the business could sell that equipment and recoup some of its costs, right? But because this piece of equipment is losing value each year, it's never going to recoup the same initial cost that it had, right? And so what we can say, at least for tax purposes, the amount of value that the piece of equipment loses each year can be considered an ordinary or necessary expenditure. Okay? Because remember our definition of ordinary necessary expenditures. So that's money that the company is never going to get back, right? You pay your employees, you pay for materials, right? That's money that is kind of expended. It's used up, right? When you buy a large asset, it's not really like that, right? Because that asset continues to hold value over several years, oftentimes, right? And so, you can't, it's not really fair to say that, let's say that you purchased a truck for $50,000, right? Let's say that you buy that in year one. It's not that $50,000 is completely lost to the business at that point, right? Because after that year one, you can sell the truck maybe for like $35,000, right? And so, you should not be able to deduct all $50,000 of that expense, but only the amount of value that you lost. Okay. Because if you can imagine, if you could do that, then there's a lot of tax shenanigans that you can do, right? You could buy large pieces of equipment, maybe use it for 1 year, and then sell it right away. And so you get all the tax benefit, but still are able to sell that asset for a large amount as well, and you kind of end up with more money than you should. All right. Any questions on this? Okay. All right, so I'm gonna give you another definition here. And so, we have this graph here that shows the current value of an asset over time. The current value of an asset actually has a term. Okay? And so that term is called the book value. Book value gets its name because it's currently the value of an asset in the books, right? You're not actually realizing that value because most of the time, the company is going to maintain that piece of equipment, right? So just the theoretical value that it has is only within the tax books of the company. Okay? So the book value refers to the current value of an asset if it were to be sold at that particular time. Okay. All right. So the formula for book value, it's pretty straightforward, but might as well just put a formula to it. And so the book value usually starts at the initial cost, right? And then from that, we can subtract all the depreciation that has occurred up to that point. And then as we start to do examples with depreciation, we're going to keep track of the book value in our calculations. Okay. And ideally, what you should see is that, depending on your depreciation scheme, your book value is going to steadily decrease over time. Okay? All right. So before we get into calculations, let's talk a little bit about what businesses generally want. Right? So generally, it is very advantageous for a company to depreciate um, the value of an asset all at once. Okay. And so if they purchase a piece of equipment for $10,000, in a certain year, they want to have a $10,000 deduction in that same year, right? So they don't want to wait. Okay? Because if you were to depreciate the entirety of an asset's purchase up front, this would give you a large tax break, in the present day. Versus spreading it out over several years, usually. Okay. And one thing that we've learned a lot through all of our economic analysis problems that it's very valuable to have money today, right? Because then you can kind of recoup a lot of that cost and you can spend that money on other things. Versus if you spread out that tax break over several years, it'll take longer for that tax break to kind of come back to you. And that's usually not as advantageous as kind of doing it all up front. Okay. So I want you to keep this in mind because what we're going to go over from here is different depreciation strategies or schemes, I should say, not strategies. Because a lot of times you don't have a choice in terms of what depreciation you can use. But generally you want to give your biggest tax break up. Okay. All right. So for the last 15 minutes of class today, I'm going to introduce the four different types of depreciation schemes. That we'll definitely expand more about next week. But let's kind of introduce them today. Maybe we'll get through straight line depreciation, and then we'll leave the other ones for next week. So there are four main ways. There are four main ways to compute the depreciation of an asset. Okay. Number one. Number one is the most straightforward way. It's called straight line depreciation. Number two, it's called declining balance. Number three is called bonus depreciation. And then number four is the longest one. Four is called the Modified Accelerated Cost Recovery System, or MACRS. The last one there was created in an attempt to kind of simplify these calculations, because these can get you'll see very soon these calculations, even in their very simple form that we're going to be doing these examples for, they can get quite difficult. And so, having a kind of a streamlined system is more has a lot of benefit to it. Although it's not really streamlined for the business, it's more streamlined for the IRS. So, but we'll get there. All right. So the difference between all these schemes, and the reason we have four of these, is that each of them will decrease the value of your asset in different ways over time. Okay. So it's important to kind of know all of these different ways. All right. So let's start with straight line depreciation. I think that's probably the only one we have time for today. So let me introduce it, and then we'll do kind of a quick example for it. All right, so in straight line depreciation, this is the simplest form of depreciation. So under this scheme, we make the assumption that the asset loses a fixed amount of value each year. Okay. So each year that you use it, year one, year two, it's going to lose the same value amount each year. Okay. The reason it gets its name is that when you lose the fixed amount in a fixed amount of time, right, and you were to graph the value over time, it ends up looking like a straight line. Okay? So the graph that we showed earlier for the kind of the thought example when we first introduced depreciation, that was straight line depreciation, because the line from where we started, the initial value, all the way down to the end, was a complete linear line, and each year we lost a fixed amount of value. Okay. All right. So to compute the amount of straight line depreciation, what you're going to do is you're going to take B. Actually, let's not use symbols. Let's just use the actual. So the amount of straight line value is you're going to take the initial cost of the asset. Okay. From that, you're going to subtract the salvage value. Remember, salvage value is the amount that you are theoretically able to sell the asset for at its end of life. Okay. divided by N, which is the product life or the useful life of the asset. Written a lot of really ugly formulas today with full words in them. I think it's better than writing a symbol and then define the symbol. So just writing the full words, because these equations are not complicated. They're quite short, and so I think the hard thing is kind of knowing what you need to plug into the formula. So that's why okay. And of course, we are doing this for tax purposes. So each year when you compute your taxes, this amount is deducted from your taxable income. Okay. Any questions on this before we jump into an example? Okay. All right, so let's do an example. I don't know if we're going to be able to finish it today, but we can at least start it. And then we'll have a long break because of the midterm, and then we'll pick this up again next Thursday. Okay. So let's say that your company recently purchased a truck for $50,000. This truck is expected to last for 5 years, so the useful life is 5. And at the end of the 5 years, the salvage value, or what you can sell the truck for, will be $10,000. Based on the capacity of the truck and based on its productivity, the truck is expected to generate an additional $20,000 a year in revenue. All right. And so if we let's assume an interest rate of 10%. And let's assume a federal tax rate of 21%. So we're going to assume for now that we're in a state that doesn't charge state income taxes. Okay. Let's compute. Let's compute two things. And so let's compute the before tax present worth. or maybe I should say with the without tax present worth, right? So if taxes weren't a thing. Okay. Number two, let's compute the after-tax present worth. Okay. And in order to do that, we need depreciation scheme. So let's assume straight line depreciation. That's the only one we know. All right, so that's our example here. So any questions on just the setup for the problem? All right, so let's go ahead and get started. So let's start with the before tax present worth. So we can actually do this right now. We know we have all the tools for this. Okay. And so just like we usually do for these types of problems, we're going to ignore taxes. And so the present worth of the truck is equal to, we take the initial costs, which is the minus $50,000, plus we know that we're going to have $20,000 a year in revenue. So that's going to be 20,000. Okay. Since that revenue is occurring each year, that is a uniform series. And so we're going to do P over A, 10%, and 5. Okay. And since we know that this truck is expected to be salvaged for $10,000 at the end of the 5 years, let's do plus 10%, 10,000, P over A, or P over F, excuse me, 10%, and 5. Okay. All right, so this is a standard present worth type problem. So we have our conversion factors that we can look up in the compound interest tables. Okay. And so if we run this calculation, we look up the compound interest table for 10%, or use the formulas, and what we get is a present worth of $32,029. Right. So if we ignore taxes, or in the case, we're either we're very good at evading the IRS, then the present worth of this truck is about $32,000, right? So I'm doing this, not only just, give you guys just one last bit of practice before the midterm, but also just to kind of illustrate to you how much of a difference taxes will make. Okay. Okay. Let's do the same thing, but now let's include taxes. Okay. So before we start actually computing things, let's compute the straight line value. Okay. So we have everything that we need in the problem. So we have the initial cost, which is $50,000. We have the salvage value. The salvage value is 10,000. And we have the useful life, which is 5, right? So we take 50,000 minus 10,000 divided by 5. That gets us $8,000. Okay. And so each year that we use the truck, we're going to assume that it's going to lose $8,000 of value. Okay. So to compute the after-tax present worth, it actually gets a little bit more complicated. With straight line, it's not that complicated. We could probably do this without making a table, but you're going to see later on that once we start factoring in the other depreciation schemes, it really helps to make a table to kind of organize all these things. So let's make a cash flow table. Okay. I'm just going to show you kind of all the different columns that we have here, and then we'll actually fill it in after the midterm. Okay. Okay. So the first column here is going to be the year or the time period. Okay. Second column here is going to be a column called before tax cash flow. Okay. Next, we have all of our deductions. And so in this case, we don't have any ordinary or necessary expenditures. We only have depreciation. Okay. Next column we have is for the taxable income. So that's how much income we're going to be taxed on for that year. Next, we have the taxes. And then finally, we have the after-tax cash flow. Okay. So it's a lot more information, and these problems definitely do get on the tedious side. And so, what I've seen people do, especially for the homework, the next homework after the midterm, is you use like a spreadsheet program like Google Sheets or Excel to kind of organize your calculations. And I think that's a really smart thing. Okay. All right, so I think that's all we got time for today. So next time I see you guys will be on Tuesday for the midterm. So please make sure you're here for that. If you have any questions before the midterm, remember I have office hours today, right after class. I have office hours virtually on Monday from 11 to noon as well. So definitely make use of that if you have any last minute questions. But best of luck studying. I hope you guys have a good weekend, and I will see you on Tuesday. Homework 3, problem 2, part A. Sure. Yeah, let's take a look. No. Let me share the screen. Actually, let me just pull it up on my iPad here. Oops.
Instead of converting to present and the future, I converted everything directly into the future. On just now.
Classes, one.
Yeah.
Homework 3. This one. Okay, so you said problem. Sorry, I lost the chat. Problem. Homework 3, problem 2, part A. Okay, so part A. Okay, so a popular chain of tea and coffee shops called 8 Branches wants to open up a new location. There are 2 locations under consideration, one near high school and one near local college. So this is a pretty standard present or type problem. So we're considering 2 different options here. So the business is considering opening a location either next to the high school or next to the college. And so what you're going to do is that for each option, I would definitely draw a cash flow diagram for each option, just so that you can compute the present worth more easily. Okay. Oh, sorry. So I didn't finish reading your question. So for the college specific. Okay. So the college location will be a bit more expensive. It'll have an initial cost of 2.55 million and draw in a revenue of $500,000 per year. And the revenue is expected to grow by $30,000 each year as it gets more popular. So for the college location, we have 3 different cash flows here. So we have the initial cost, which is the 2.55 million. The revenue, $500,000, that is a uniform series. And then the growth is a gradient. So basically you're gonna convert all 3 of those cash flows into a present. So let me see if I can this. Nope. Okay, let me bring back my iPad here. And then so the present worth of the college location is equal to, we have the minus 2.55 million, so minus 2,550,000 plus how much was it? $500,000 in revenue. $500,000 in revenue. Come on. I don't know why my iPad's bugging out right now. There it is. Okay. That was weird. Plus $500,000. P over A, I, and N, plus 30,000 P over G, I, and N. Yeah. So the interest rate, I think the interest rate for this problem, let's see, the interest rate is 7%, and the analysis period is 10. So you're going to set I is equal to 7 and N is equal to 10 for that. And so you look up those conversion factors from the compound interest table, and you plug it in, and then you should get the result that we have right there. Yeah. Okay. Does that make things a little bit more clear for that one? The gradient part of it. Okay. Yeah. So P over G. Let's look at the compound interest tables actually. So we know that this factor right here is P over G, right? So when the problem basically says that you have kind of an increase each year, that's what's considered a gradient. So that's G, right? And so if we look, let's look at the miscellaneous materials, compound interest tables, right? So let's go to the compound interest table for 10% or 7%, excuse me. Okay. So we have this column you see on the very far right called P over G. And so we're going to look up that value for 10, right? So we're on the compound interest table for 7%, and we're looking at the P over G column. And if we go to row 10, you can see that the factor is 27.716. And so if we go back to our expression here, right, this 30,000, we're going to multiply it by 27.716. Yeah. Does that make a bit more sense? Nice. Yep. And then for the 50,000 or for the 500,000, you multiply by the P over A factor. So let's go ahead and look that up real quick. And so the P over A factor, that's this column right here. And so we go to row 10. Row 10 is this one right here. And so this conversion factor is 7.024. And so we come back here, 7.024. And so you do minus 2.5 million plus 500,000 times 7.024 plus 30,000 times 27.716. And that should give you the number that's on the homework. Okay. All right. Should N always be the period given? Yes. Yeah. So N is always the period that's given. Yeah. So the problem will pretty much always tell you what to plug in for that. So just whatever the useful life is or whatever the period that's given. Mhm. Yep, no problem. All right, I'll see you next week. Thanks, you too.